We are like hawks looking at every new economic data point. That's the reality right now. And we got some GDP numbers today in the U.S. We'll get some GDP data heading into tomorrow, some inflation numbers in the U.S. But many of you want to know what this all means for interest rates, or specifically this idea that cuts could be coming. Well, in the market right now, Bloomberg data is suggesting the markets are pricing in more than 50 basis points worth of cuts in this country by the end of the year. So call it a couple of cuts at least, maybe 3. In the U.S., the markets are currently pricing in, give or take 3, at least 75 basis points of cuts, possibly 3 to 4 next year. Of course, that's just expectations. Let's get some perspective now from David Doyle, who recently updated his own forecast for both of the economies. He's head of economics at Macquarie. Nice to see you.
Good to see you, John.
Okay. We're just going to cut right to it, right? Because we can explore the data points, but I think a lot of people are trying to figure out where the economy is headed and what's going to happen with interest rates. Let's start with the Canada story. So is that what you have seen in the market pricing, that call it 2 to 3 cuts is what people are anticipating for Canada this year?
Yeah, I think the market pricing is close to 3 cuts over the course of the rest of this year for Canada. That's right, John.
And how would that compare with what you think will happen?
We think that that's a bit too optimistic in terms of the number of cuts. We're thinking now that it's probably closer to 2 cuts. We think the economy actually looks more resilient than it did a few months ago.
What is it that you see out there that makes you sort of conclude a resilient economy is in front of us right now?
So, I mean, the growth numbers have held up, particularly in the U.S., and the Canadian economy has been, highly synchronized with the U.S. over time, so that's part of it. But then again, also you're seeing signs of housing activity picking up, right? Existing home sales have shown growth, and if that occurs, that's going to create some positive growth momentum here in Canada.
We have seen literally in the last 2 days 4 Canadian banks announce more provisions for potentially bad loans, in part because of uncertainty on the economy. Does that sort of balance the scales a little bit on sort of a resilient Canadian economy?
Yeah, I think that's something that's notable, but I also note that their stock prices have tended to rise on that news. So I suspect that that's a bit of a lagging indicator.
I see.
And look, there are headwinds ahead. I don't want to sound too, be looking at things just with rose-colored glasses.
Yeah.
But I just think the balance of probabilities have shifted a little bit, and they suggest a more resilient economy than they did a few months ago.
And the biggest part of that would be a resilient American economy.
That's right.
Yeah.
And the U.S. is showing strength in consumer spending. Its housing sector looks to be on potentially an upswing, and business investment has been steady. So in that context, it's hard to see Canada really having a hard landing.
All right. Now, I'm just trying to do the math here, because we listen to all the pundits all the time and we look at what's being charted into the markets. But I mentioned it does seem like in the U.S., there's still in the market projecting there could be more cuts in interest rates this year than Canada. Is that fair based on the numbers that you've seen, just in terms of the market's actual thinking?
Yes, that's what we see priced in the market. Now that gap has narrowed a little bit from where it was a few months ago, but certainly that seems to be the case.
So if you are expecting possibly fewer rate cuts in Canada this year versus the market, and that is because it's part of a resilient American economy, do you think the market has it wrong on how many rate cuts we'll see in the U.S.?
Yeah, that's right. So we think the Fed is likely to only ease by about 50 basis points. So that's 2 cuts. The market's at, I think, 3, maybe even a bit above 3. And again, it just comes down to the resiliency we're seeing there. And I think that the market, I think, got overly optimistic on how quickly inflation was going to come back towards that 2% target. I still think we're heading there. It just might not be as fast a process or as quick a process as what the market had become to expect a month or 2 ago.
I mean, interest rates impact everyone differently, so I'm not going to put everybody in the same boat. But across society, it feels like people would like to see lower interest rates because they were dealing with inflation and frustrated by that. And if that's starting to be contained, they'd rather interest rates were lower versus higher. If central banks are going to feel pressure, and let's face it, they have from government officials, whether they can tune out that noise or not, to lower interest rates, how are they going to message around fewer cuts if ultimately your projection is correct and they cut less than what the market is expecting.
So I think the big shift that we're anticipating to occur, this year and even into 2025 is that central banks, both in Canada and the U.S., will start to emphasize the potential that the neutral interest rate is higher than what their current estimates suggest. So in Canada, they provide a range of 2 to 3%. In the U.S., the Fed is around 2.5%. I suspect that those estimates will begin to rise this year, and that will be something that central banks will say, well, look, it might appear on the surface that we're restrictive, but we're not sure how restrictive we actually are given the uncertainty of the neutral rate. And I think you'll start to see that estimate of the neutral rate from the Fed, from the Bank of Canada, move higher over the course of the year.
Hopefully they work on that language a little bit just so that they don't leave confusion out there in the marketplace. I know that when you've joined us in the past, you have talked about how deeply indebted we are as a nation and how that was a concern for you. You started the conversation by highlighting the U.S. economy is resilient. That's helped our economy. Maybe that takes some pressure off needing to cut rates. But does that mean we're out of the woods when it comes to navigating huge debt loads?
No, I don't think it does, right? And I think the metric that I think a lot of Canadians should be looking at now is not necessarily real GDP, but real GDP per capita. And if you look at that, Canada largely suffered a recession in 2023. Real GDP per capita contracted. We've seen a significant fall from its peak, and it continues to struggle. I think in large part what prevented the recession dynamics from occurring was strong population growth. So certainly, I think partly that the struggles of real GDP per capita have been the result of those elevated interest rates. I do think, while we only have 50 basis points in cuts in 2024, I do think you'll see more significant relief from the Bank of Canada in 2025. We have 125 basis points in cuts occurring during the calendar year of 2025. And a lot of that forecast, John, is driven off of the increase in the mortgage renewal headwind that occurs. Of course, in 2025, we lap the lows of interest rates of 2020 when it comes to people's mortgage renewal. We think that will spur the BOC to ease more aggressively in 2025 than what we anticipate in 2024.
Okay. Well.